Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing stuff companies don't want you to see in their SEC filings. You know, like finding out if your favorite company is secretly juggling a mountain of debt or if their fancy accounting is hiding anything juicy. Today we are diving into B, Riley Financial's 2024 10K filing. So, what's the big story here? Well, buckle up because B. Riley has been making some serious moves. They're reselling off parts of their business left and right to pay down debt. It's like they're cleaning house, but with a financial twist. Let's unpack what this means for them and for you if you're invested. And hey, if you want more of these deep dives into the companies you care about, make sure you're subscribed and join our Discord community linked in the description below. Alright, first up, B. Riley Financial, which trades under the ticker Riley, is a diversified financial services company. Think investment banking, wealth management, direct lending, and advisory services. They've got a lot going on with over 2,500 professionals and offices across the globe. But what is really interesting is their move to cut debt. That's a massive reduction in debt, cutting it down by about $600 million in just 1 year. This is a huge deal because high debt can be a huge weight on a company, especially when interest rates are high. They've been selling off assets to make this happen. Let's look at some of these sales. They had a big brands transaction in October 2024, involving brands like Hurley Justice and Scotch and Soda. They got about $189 million from that. Then BB Stores, a subsidiary, sold its brand assets for another roughly $47 million. In November 2024, they sold a big chunk of their Great American Group, which included their appraisal, valuation, and real estate businesses, bringing in about $167 million for the company. And just recently in March 2025, they sold Atlantic Coast Recycling for about $69 million after adjustments. They also offloaded part of their wealth management business and their Glassratner and Faber financial consulting businesses. It's clear they're seriously trimming down their operations to focus on paying off debt. Now let's look at the numbers for the year ended the 31st of December 2024. Total revenues dropped significantly to about $839 million from $1.5 billion in 2023. That is a nearly 43% drop. A big reason for this was the massive decrease in fair value adjustments on loans, which went from a gain of $20 million in 2023 to a loss of over $325 million in 2024. This signals serious trouble with their lending part of the business, especially with related party loans seeing huge negative fair value adjustments. This right here is a massive red flag. Their investment in Freedom VCM, which was worth almost $300 million at the end of 2023, is now worth absolutely nothing. The report explains that Freedom VCM, the parent company of Franchise Group, or FRG, filed for bankruptcy protection in November 2024. This single write wiped out a huge chunk of their investment portfolio and contributed heavily to their overall net loss. Speaking of losses, the company reported a net loss attributable to B. Riley Financial Inc. of over $764 million for 2024. This is a huge jump from a net loss of about $100 million in 2023. The bad news cascades into their earnings. Pairs here too, with a basic loss per common share of over $25 in 2024. A big drop from the nearly $4 loss in 2023. Beyond the direct financial hits, the company has also been forced to write down the value of its goodwill and other intangible assets. In 2024, they took impairments of over $105 million, up from $70 million in 2023. This often means that the acquired businesses are just not performing as well as they hoped, so their value on paper has to be reduced. Let's dig into some specific loan issues. They had significant fair value adjustments on loans to Con-S Inc., a retailer. In 2024, the adjustment was a loss of over $71 million, largely due to Con-S filing for bankruptcy in July 2024. This shows how risky their lending activities can be, especially for companies in a struggling consumer market. Now, they do list a lot of risks, as expected. The big ones highlighted include the volatility of their revenues, potential legal liabilities, and boy do they have a lot of those lawsuits seem to be popping up everywhere, and the ongoing fallout from their investment in Freedom VCM. They also mentioned cybersecurity risks, relying on third-party providers, and the potential for employee misconduct. Their substantial debt is also a big concern. They have over $1.8 billion in debt at the end of 2024. And here's a key point: their publicly traded senior notes are unsecured. That means if things go south, the people holding those loans get paid back quite a bit later than those who have secured loans. And in a classic sign of trouble, management reports they have identified material weaknesses in their internal controls over financial reporting. This means they found found serious issues that could lead to errors in their financial statements that might go unnoticed. They're working on fixing these, but it's a clear indicator that things are not internally rock solid right now. Overall assessment, looking at the big picture, B. Riley Financial is clearly in a period of significant restructuring and deleveraging. They've made a strong effort to cut down their massive debt load, which is a positive, selling off assets, even valuable ones. To achieve this is a financially sound move when burdened by high interest payments. However, the enormous write-downs, particularly the complete loss on their Freedom VCM investment, and the recent bankruptcy filings of Cons and FRG are significant blows. These aren't just minor hiccups, they point to potential underlying issues in their valuation of investments and their risk management for loans and partnerships. The material weaknesses and internal controls also raise a serious flag about the reliability of their financial reporting, even if they are working to fix it. On the bright side, their core capital markets and wealth management businesses still generate substantial revenue, but these are being overshadowed by the losses in other areas. The direction seems to be focusing on core strength while shedding non-performing or high-risk assets. The key question remains, can they restructure and deleverage fast enough to outrun the severe losses and risks they've taken on, and will their core businesses be strong enough to carry the company through this difficult period? For now, it is a high-stakes game of financial recovery. Alright, that is our breakdown of B. Riley Financial's filing. What do you think about their debt reduction strategy and those massive investment write-downs? Is this a smart pivot or a sign of deeper problems? Let me know in the comments below. If you found this breakdown valuable, smash that like button and subscribe to Corporate Decoder for more. Don't forget to join our Discord for discussions and early access to our research. Thanks for watching, and we'll see you in the next one.